Recipes for technical trading success in Cook's Kitchen.
You think you're ready to trade the VIX with futures, options, and ETFs? Not until you watch this video. I'm Kevin Cook. Welcome to another edition of Cook's Kitchen. Let me show you an article I wrote a couple of years ago to help people understand the VIX. 7 things you need to know. It's on valuewalk.com. If you want to find it, just search VIX 7 things you need to know. And there are 4 of them right there. A lot of technical mathematical stuff, but this is the stuff you need to know if you're going to understand the VIX. The VIX is a derivative, and you could call the ETFs like UVXY or TVIX or VXX, you could call them a derivative of a derivative of a derivative, because even the VIX is a derivative. So we'll get into that in a minute, but what's my street cred on this? Listen, I am not a professional options trader, but I know a lot of people who are. I learned from the best. In the 90s, I was an option clerk at the CME and the pits, and options traders, they're really trading volatility. So it doesn't matter if they're trading grains or Eurodollars or currencies or the S&Ps. It's all the same to them, so they understand the VIX. Then I took classes from the master in this business, Shelley Nattenberg, who wrote the book Option Volatility and Pricing. If you really want to get into understanding options and volatility, that's the book you need to read. Then I was very fortunate in 2008 to go to work for a firm in Chicago here called Peak 6. Now these guys are like the Goldman Sachs of options trading on Wall Street. Big market makers, and I was there during the crisis, and I got to take my knowledge to the next level watching these guys do their stuff. So again, I'm not a professional options trader. If you are, you know more than me in terms of trading implied volatility, but I know enough to try and help people. So that's what my article does. Refer to that article on valuewalk.com. VIX 7 things you need to know. You do need to understand that stuff if you're going to go further as an options trader or somebody trying to trade the VIX. All right, now let's talk about where people go wrong. People who don't understand options volatility look at the VIX and they think they can chart the VIX. Now, I'm just going to point to this chart because I want to show you some things on here. This is a 3-year chart, I believe, or at least a 2-year chart. Yeah, it's a 2-year chart of the VIX. So what a technical trader will do is say, oh, look at this trend line here. I'm drawing a line here, and the VIX broke out. New trend. Or using moving averages. You want to see how bad moving averages are to use on something like the VIX? Look at the MACD. You think you get reliable signals? As soon as you get a signal from the MACD, it's useless. It's gone. This is the nature of the VIX. It is a stochastic process. If you're a quant of any kind, you understand that. It just ebbs and flows. It oscillates. And if you read my article, you also see what the VIX tends to do is it tends to drift and then jump. It'll have a spike. It doesn't go into long-term trends. Maybe short-term trends, but your timing has to be extremely on. So in that article, I also talk about what the VIX is actually measuring in terms of standard deviation and implied volatility. You need to understand what the VIX is in terms of standard deviation and implied volatility before you can even go further with it and start trading the derivatives based off of it. Because if you remember what the VIX is the implied volatility of S&P options. Okay, so S&P options, there's your first derivative. Then the VIX is based on the implied volatility of those options. There's your next derivative, and then you're getting into there's futures based off of that, and then the ETFs based off of that. So it's a derivative of a derivative of a derivative once you get out to one of these strange animal VIX ETFs. So that's why you need to understand the ground floor before you can go any further and make use of these very far removed instruments. All right? Now let's see. So now I'm going to show you a great tool. This is a tool you want to become very familiar with. You can look at it every day and understand what's going on with the VIX in terms of where it's at on the VIX spot index itself and then the futures. All right, this is VIXCentral.com. That's all you have to type in. VIXCentral.com draws all the data from the CBOE where these products are traded. So what you're looking at right now on the morning of September 16th, that green line is the spot VIX calculation. And remember, the VIX is calculated based off the implied volatility of S&P options over a 30-day period. So it includes the front 2 months of S&P 500 index options and their implied volatility. And if you don't understand what I just said, you need to go and read my article, because you need to understand what somebody says when they mean that the VIX is the implied volatility of S&P 500 options, and it's the first 2 months on a rolling 30-day basis. Sounds complicated, but so if you don't understand it, then you have no business trading any VIX products. All right, skipped ahead here. So back to VIX Central. There are several pages on here. This is the default page, which shows the VIX futures term structure. Again, the green line is the spot VIX index calculation. These are the futures months: October, November, December. And what do you notice here? This pattern. Okay, it's sloping upwards. This is normal. This is how the VIX futures tend to look. It's a little cheaper right now, but if you want to buy VIX futures, for a few further out months, you're going to pay more for them. The VIX is trading at a higher level, a higher implied volatility. Well, recently, what happened when the VIX shot up to 50, the spot index? Well, those front month futures shot up too. And they were pushing up into 30. So you had a VIX futures curve that looked like that. So instead of this normal, what we call contango, the front months were elevated, and then things chilled out. You have to understand this contango business, because the VIX ETF products, or ETPs, sometimes I'll say ETP, exchange traded products, ETP, because there are ETFs and there are also ETNs, exchange traded notes. And that's where things can get complicated with those weird animals. All right, back to the curve here. So we're in contango. When you're in contango, the VIX ETFs get hurt because they constantly have to pay up to roll out of the futures month that they're in and into the next futures month. So they're constantly selling low and buying high. That's why contango. That's why if you look at a chart of VXX or UVXY, you'll see an all-time high way up here, and the thing is just slowly degraded and decayed over time because of the VIX's normal state, the VIX futures normal state, which is contango. Right now, there's a little bit of backwardation where since the spot is higher than some of those forward months, things can work in favor of VIX and UVXY, but your timing still has to be right on. All right, I think I've covered all I want to. Go to VIXCentral.com and get familiar with those charts. There's other tabs there to understand the VIX curve. And then find my article, VIX, 7 Things You Need to Know, on ValueWalk.com. And then email me or find me on Twitter or StockTwits at Kevin B. Cook. Give me your questions or complaints, and let's understand these products before we trade them. All right, thanks for watching me in the kitchen.